Hi, everyone. I'm Troy Johnson, Executive Vice President of Service and Sales at Mutual of America Financial Group. Thank you for joining our webinar, Secure 2.0, What's Coming in 2006. Just a couple of quick housekeeping notes during this webinar. First off, you can download the slides by clicking or scanning the QR code on your screen. You can use the Ask Question box to submit questions, and if your question isn't covered, we'll be sure to have one of our colleagues follow up with you after we're done. With that, I'm pleased to introduce our speakers. Joining us today, we have Nick Caraba, Senior Vice President and Associate General Counsel, as well as Morgan Pace, Vice President, Client Relationship Manager Operations. Thank you both for joining us.
Thanks, Troy. It's great to be here. I love sharing details about Secure and Secure 2.0 and happy to do it again.
Great.
Likewise, this is a great chance to dive into the Secure Act provisions and show clients how their plans and participants are going to be impacted. I'm looking forward to it.
All right, thanks, Morgan. Well, we have a lot of ground to cover today. We're going to focus on really two key provisions of the Secure Act that plan sponsors need to know about as we head into 2026. First off is the long-term part-time worker provision. And the second thing we're going to cover is the Roth Catchup contribution provision. We'll explore the background around these provisions, highlight what you need to know as a plan sponsor so that you can better understand how these may impact how you run your plan now and in the future. And we'll let you know what you can expect from us at Mutual of America, including monitoring for regulatory guidance, assisting with plan amendments, and additional communications to help you navigate Secure 2.0 in the year ahead. Okay, so as you may know, the Secure Act was signed into law in December of 2022 and follows up on the previous Secure Act of 2019, continuing with the objective of broadening the appeal of workplace retirement plans such as 401k and 403b. There are more than 90 provisions impacting retirement plans and participants, but today we're going to focus, like I said before, on two. The Act as a whole provides employers with opportunities to enhance their plan provisions and simplify plan rules and administration. For plan participants, for your employees, the Act offers the opportunity to save more for retirement and achieve financial success for the future. As you all know, the long-time part-time worker provision, which has been in effect for a few years now. Nick, we've talked about this segment of the labor force in past webinars, but I was hoping you could give us an overview of the provision and shed some light specifically on what's coming up in 2026.
Yeah, you bet. Thanks, Troy. You did mention we've covered this in prior webinars. This has been a provision that was first enacted back in 2019 under the first Secure Act. It was then applicable only to 401k plans, and then later in Secure 2.0, it was extended to 403b plans. But just to take a quick step back, and just to remind everybody what the baseline rules are, generally, when you have a retirement plan, you have to include all your employees. There are certain limitations to that. You need to only extend the plan availability to folks that work 1,000 hours or are older than 21. What the long-term part-time provision did in the first Secure Act is to change those rules and to say, rather than waiting for someone to work 1,000 hours to be eligible to enroll in the plan, you only have to work 500 hours in a year. In the first iteration of the rules, it was you had to work 500 hours a year for 3 consecutive years, but now it's been reduced. So now you have to work 500 hours a year in 2 consecutive years to be offered the opportunity to make elective contributions. Now, the important part there is that you're only, as a plan sponsor, required to allow those individuals to make elective deferrals, meaning salary contributions from their paycheck. You don't have to offer matching contributions, and you don't have to offer non-elective contributions, even if you give those contribution types to your other employees. In addition, what Congress and the IRS have done with regulations is to create some safe harbors on non-discrimination testing. Those get super technical and a little bit too much in the weeds for our presentation today, but rest assured our customer service representatives at Mutual of America will be able to walk you through all those annual compliance testing requirements when they come due. But just know that as a general matter, for long-term part-time folks, you do not have to include them in most of the non-discrimination testing that's available.
So thinking about this for a lot of our clients in the past, specifically our 403B plans moving forward, we've always focused on participants that have worked 1,000 hours a year or more. And this is certainly putting a spotlight on employees that work less than that. So this will be a big change for our 403B plans moving into 2026.
That's right. And as I mentioned earlier, what we were waiting for since really the end of 2022 when Secure 2.0 was enacted by Congress for additional guidance from the regulatory agencies, and here particularly the IRS, the Department of Treasury and IRS, although we do have some guidance from Department of Labor as well. But what we do know from the regulations, and I'm going to ask Chris if you can move to the next slide, please, is what we have for 401k plans are proposed guidance, proposed regulations. We are permitted to comply with them in a good faith way, pending the release of final regulations, but the IRS hasn't provided those yet, even though these provisions are effective currently. So what lawyers like me call good faith compliance means do your best, and you hope you're right, and you realize that the IRS generally will provide some enforcement relief during the period of time when there's this good faith compliance. So there's a lot of information on this slide. I don't want to go through every single bullet point. I think some of the key points to keep in mind: if you are a plan, either a 401k plan or a 403b plan, that use what's called elapsed time counting method, which is a way of crediting service with the employer for purposes of eligibility to participate in the plan, you don't really have to comply with these long-term part-time rules at all. What that part-time long-term part-time provision does is to say, if you work 500 hours in 2 consecutive years, you must be offered eligibility to make contributions to the plan. If you're not counting hours because you're using this other method called elapsed time, then you don't have to count hours. What you have to do, however, is to include all your eligible employees, long-term, either part-time or full-time, in the plan after 1 year of service. So beginning on hire date, 1 year after that, they are offered the opportunity to enter into the plan. There's also IRS guidance specifically for 403B plans, and that's Notice 2024-73. What that does in particular, that I wanted to highlight here for our 403B plan sponsors that are listening in, is address sort of a particular complexity with this rule as it collides with prior 403B rules. That prior rule, which is still in existence, is the universal availability rule. That basically says that if you sponsor a 403B plan, you have to provide the opportunity to enroll to all of your employees. Now, there are certain statutory exclusions. And one of those exclusions is that you don't have to offer the opportunity to enroll to employees who, this is a regulatory term, normally work less than 20 hours a week. Okay, so clearly those are part-timers. And this collides directly with this new statutory requirement for long-term part-time employees. What the IRS has said is that, well, you can still have the less than 20 an hour exclusion for plan eligibility, but you can only do it for 2 years. So for 403B plan clients who have part-time workers and have in their plan document the exclusion for those who normally work less than 20 hours, you can continue doing that, but only for 2 years if those individuals work 2 consecutive years, and then they must be offered plan eligibility. One more highlight that I'd mentioned, I said about the Department of Labor. They didn't directly address this issue, long-term part-time, but they did in an indirect way. When they released new Form 5500 guidance, what they did is to say for purposes of counting how many plan participants you have, you will now only count individuals with active balances, with account balances in the plan. Prior to that, it was any eligible employee to the plan. And the Department of Labor recognized that with this long-term part-time provision going into effect, for some employers, the number of eligible employees is going to explode, even though those individuals might not even be contributing to the plan. And what that does is it may have bumped up certain employers over the 100 participant count threshold, which then triggers an annual audit. So for employers that are on the bubble and they have lots of part-time employees, if those employees, when offered the opportunity to enroll, don't contribute to the plan, they don't need to be counted for 5500 purposes. Troy?
Yeah, excellent. Some great points there. I think, my 2 takeaways listening to you, Nick, is number one, as a plan sponsor, checking with us, talking to your client relationship manager and understanding, does your plan currently use elapsed time, or do you have counting hours in your plan? And the second thing that I thought was worth noting again was the participant count. A lot of our clients are maybe, wavering close to that 100 participant count and maybe, pushing them towards an audit or away from an audit. So good to know that we do not need to count these people unless they have account balances. So thanks, Nick, for that. Very good stuff. Morgan, keeping all of this in mind, what are some of the key issues that plan sponsors need to know about?
Yeah, so some important key points that plan sponsors should be aware of is once it's determined that someone qualifies as a long-term part-time participant, these participants can contribute all employee money types that's permitted by the plan. So for example, employee money types would be what we call traditional employee contributions, otherwise known as pre-tax, Roth contributions, after-tax contributions, or rollovers. Okay, so these participants are going to be able to contribute all employee money types permitted by the plan. By default, long-term part-time employees do not automatically receive employer contributions, but you can choose to include them through a separate amendment that's not related to the Secure Act. So for example, if your plan offers employer matching contributions, employee contributions made by long-term part-time participants by default will not need to be matched, okay? So nothing will be incorporated into your provisions that says that you will need to match those contributions by long-term part-time employees. However, if you want them to, you can certainly modify your plan provisions to encompass employer contributions for long-term part-time employees. You should just let your client relationship manager know as soon as possible so that they can start the amendment request process for you. Additionally, standard long-term part-time provision amendments, so what I talked about earlier, just referring to employee contribution types, those amendments will be incorporated into plan documents by December 31st, 2026. Okay, so when I say standard long-term provision amendments, I'm referring to those long-term part-time participants to be able to contribute their own employee contributions. Those provisions are going to be incorporated into your plan documents by Mutual of America by the end of what we're referring to as the remedial period, which is December 31st, 2026. The last important note that I want to make on this is that although your plan will be operating as of January 1st, 2026 to allow long-term part-time participants to contribute employee contributions, the language that incorporates that into your plan documents will not be produced until later in the year, as I mentioned, before the remedial period deadline of December 31st, 2026. Okay, so as we dive deeper into this provision on the next slide, there are some important considerations to keep in mind. So this provision helps employers, ultimately, it helps employers retain long-term employees who were previously ineligible. And that can reduce turnover among your part-time staff for organizations that offer 401k, 403b, or 457 plans. It also helps individuals that may have not previously been eligible to contribute to their workplace retirement plan save for retirement. As mentioned, you do have the flexibility to include long-term part-time participants in the employer contribution piece, but by default, they will be excluded from employer contributions unless you notify us that you would like to include them in the employer contribution piece.
All right, so moving on here, plan sponsors should also know how Mutual of America can help ensure that your plans are compliant. Mutual of America will enroll long-term part-time individuals based on your selections and provide reports indicating who may be eligible based on the payroll data that you submit. These reports we think will be helpful for you at administering your plan and helping to identify which participants may now need to be offered the opportunity to participate. When we provide this data, we would remind you that it is your responsibility to review the data for accuracy and work with us so we can get the file as accurate as possible for you.
Yes, so to add to that, Troy, I'm going to get a little bit granular here, hopefully not too much, but Mutual of America is going to rely on our plan sponsors, on you all, to identify applicable long-term part-time employees. So ultimately, it's going to be your responsibility to determine who qualifies as a long-term part-time employee based on their hours worked, as well as calculate and report to Mutual of America their corresponding applicable entry dates. When it comes time to identify these applicable employees, we will schedule what we're calling an annual work order for plan year evaluations, where you can basically indicate which participants this applies to. And once that work order is created, once we create that, it will be, you'll receive a regular reminder that it's overdue. For example, if it's not completed timely, you will get regular indications that it still needs to be completed. As you may be aware, work orders are accessible via the data validation web section in OWS. So the portal that you log into, it's available through data validation web. If a long-term employee, this is another thing that's important, is that if a long-term part-time employee becomes a full-time regular eligible employee, plan sponsors must report that change to us. So you're going to need to notify us for participants that qualify as long-term part-time, but also when an employee goes from long-term part-time to a fully eligible regular employee. Okay, so those are two takeaways that once this goes live, you will need to indicate to Mutual of America who those are. For those long-term part-time employees that become full-time regular eligible employees, one of the reasons you do need to indicate to us that they're regular, fully eligible employees is because this is going to allow us to properly administer those participants. For example, allowing them to start receiving employer contributions that they would not otherwise be eligible for if they were a long-term part-time employee. You should work with your payroll providers to see if they are coding these applicable participants, both long-term part-time and those that go from long-term part-time to what we're calling former long-term part-time, which is just regular eligible employees. But depending on the data that they collect, that your payroll provider collects from you, they may be flagging these participants automatically. However, every payroll provider is different. They are all handling this differently. So it's important that you understand how they're incorporating this into their payroll platform for your plan. So I would definitely encourage you, if you're not familiar with how this will work from the payroll provider perspective, I would highly encourage you to reach out to them. I recognize I'm getting pretty granular here. We are going to provide more details about the systems and the specific go live process and timeline closer to the end of the year. You'll hear me say this a lot throughout the presentation today, but I encourage you to contact your client relationship manager if you have questions about this. They're going to be able to support you and your plan's needs specifically once this goes live within our system.
Great. Thank you, Morgan. Again, I think it's going to be really important for clients to start looking at this as we move towards January to get a good understanding of the impact. It could be very little or none. It could be significant, but we are here to help. All right. Well, thank you both for your great insights on the long-term part-time provision. I know we could spend a lot more time talking about this. It is obviously a complex topic. But in the interest of time, I want to move on to the Roth catch-up contribution provision. Nick, if you would, take us through some background around this provision.
Sure, you bet. Thanks, Troy. Unlike the long-term part-time provision, this one's pretty straightforward and is applicable for the first time in as of January 1, 2026, so coming up quickly. Take a step back and what Congress was trying to do with Secure 2.0 is to enhance participation and ease administration of plans and generally make retirement plans more widely used. What that generally does is cost the federal government money because most plan contributions that go in are pre-tax and they're tax deferred. And so the government loses that money that otherwise would be taxed. So when you see quirky little provisions like this in the law that have to do with Roth or other types that don't make a ton of sense, it's because they're looking for money. And so that's what this provision's all about. The Congressional Budget Office scored this as a $13 billion revenue raiser over a 10-year period. And why is that? It's because Congress scores these things on a 10-year cycle. So though contributions going in as Roth are taxed first, even though later on when they come out of the plan, they're tax-free and all the tax deferral is also tax-free. The federal government sort of loses money on the back end, but it's outside the budgetary window. So when you score it, it all works out good for them. So that's sort of the purpose of this bill, is that the rest of the provisions of Secure 2.0 cost money and they need to find offsets. And so what they did is to say for certain people, certain high earners, catch-up contributions are going to have to be on a Roth basis. We put some information here in the slide just to sort of remind everyone what the limits are for 401k and 403b plans. Regular contributions for 2026 are $24,500. That generally increases every year. Sometimes not, but generally in the last several years we get an increase in that. Catch-up contributions are those contributions that go above that $24,500 threshold. Only individuals who are age 50 who turn 50 in a plan year or older are eligible to make these catch-up contributions. And then also a new provision is what's called enhanced catch-up contributions. And those are for people who are age 60 to 63 only. And you can make an additional you can make an additional catch-up contribution up to a total of $11,250 in 2026. So what we're looking at here for these Roth catch-up contributions is that for everyone who's catch-up eligible, so again, those who are age 50, who turn 50 in a plan year and older, and including those in that 60 to 63 window that do enhanced catch-up contributions, if you have made more than $150,000 in what's called FICA earnings, so earnings that are wages defined under the Social Security law, then your catch-up contributions must be made on a Roth basis. So again, while the concept, I say at the outset, I said the concept is sort of straightforward. The more you talk about it, the less straightforward it becomes. What employers are going to have to do is continually look backward a year to see who in their company currently made more than the FICA threshold. That's going to increase every year, just like all the plan limits increase. So let's just take 2026 as the concrete example. Once this goes into effect in 2026, for folks that are contributing to the plan in 2026, employers will have to go back and look and see if those individuals, of any of those individuals, made more than $150,000 in FICA earnings in 2025. If they did, then in 2026, when they start contributing, if they hit the regular contribution limit of $24,500 and they want to make catch-up contributions, then those contributions have to be made on a Roth basis. And they're treated just as Roth in the sense that they go into a segregated bucket inside the plan. If they're held there for 5 years and aren't distributed until either 5 years or death or disability, they are completely tax-free. But at the outset, when they're contributed, they go in after tax. There are a couple plans here that couple types of plans that these rules are not applicable to. So Congress excluded some of the smaller startup plans, SARSEPs and Simples, and these new plans called starter 401k and 403b plans. Those are for small employers that generally want to set up pretty easy, straightforward type of plans. For those, they're not included in the Roth catch-up provisions. But generally, all 401k, 403b, and governmental 457b plans that all those plans are permitted to have catch-up contributions. Those plans are affected by these rules, and again, they come into effect the beginning of next year.
I just wanted to add to that, just to eliminate any confusion. That original FICA threshold was announced as $145,000 and has since been updated to $150,000. So what employers before might have understood the threshold to be $145,000 is now $150,000.
Yeah, that's a good point, Morgan. And that's sort of one of the complexities that we'll have to get used to. So every year that number is going to go up. But you're right, because it was odd that the first year had already been set at 145, and then just a couple weeks ago they increased it to 150 for 2020.
They changed it. Yep.
Okay, so let's go to the next slide here. So next couple slides, we're going to be talking about what are the specific actions that plan sponsors need to take to get prepared for this provision. So Morgan, we know that some plan sponsors have a plan that already has Catchup and Roth. What are some things that they should know?
Yes, so some important facts that those particular plans and plan sponsors should be aware of is, so if your plan has, as Troy mentioned, already has the catch-up provision, but also already has the Roth provision, starting in 2026, as Nick just mentioned, certain high earners must make catch-up contributions as Roth contributions. Those certain high earners are participants age 50 or older earning more than $150,000 in FICA wages in the prior year, so in 2025, with the same employer. Okay, so that's all earnings from the same employer. For these plans, from a plan document perspective, no immediate amendment is needed to allow these high earners to make catch-up contributions in the form of a Roth contribution. You do not need to immediately amend your plan to allow for this. This will be incorporated automatically. Okay, eventually, this will need to be incorporated formally into your plan documents, and Mutual of America will provide you all, our plan sponsors, with plan restatement documents and a summary plan description to account for all applicable Secure Act provisions. These documents, once released to you all, they will require plan sponsor signatures by the end of this remedial period that I keep referring to, which is December 31st, 2026. So in summary, from a plan document perspective, there's no immediate action required by you until later in the year when Mutual of America provides you with restated plan documents that formally incorporate this provision. At that time, that's when some action will be required and we'll need your signatures on those plan documents. Okay, so the next group of plans that we want to focus on and highlight here are plans that have the catch-up provision but do not have the Roth contribution provision, meaning your employees cannot contribute Roth contributions currently into the plan. If this applies to your plan, you will need to amend your plan to remit Roth contributions. These high earners that we keep referring to will be blocked from making catch-up contributions. So if this applies to you, you should notify your client relationship manager immediately before the end of this year. So before December 31st, 2025, we will need to amend your plan to add the Roth contribution feature. Our client or relationship managers are proactively reaching out to our clients that this applies to, but if for any reason you didn't receive an email, it got overlooked, please reach out to your client relationship manager to initiate this process if you have not yet heard from them. Once we get the green light from you or the approval that you're going to add the Roth contribution feature to your plan, we will very quickly provide an amendment and an updated summary plan description. And then, just like with the other group of employers that I mentioned before, we will have a more formal plan restatement before the end of next year that will incorporate this into the regular language of your plan documents, where it won't be attached like as an amendment. It will be incorporated into the full plan document, but that won't happen until the end of next year. So for now, you're going to need to initiate that amendment. We'll get it applied, and you should do that as soon as possible, ideally before the end of this year.
Let's look at some additional considerations here on the next slide. So whether you have, Roth or not, there are some considerations and benefits related to this new provision. Adding Roth certainly adds some tax diversification. It gives, your employees the option to save on an after-tax basis. This certainly appeals to younger employees, and it provides more flexibility really to everyone in the plan. And I would also note for some of your older participants that Roth assets are excluded from RMD calculations. So that's a nice feature as well. There's no fee to add the Roth. It's just a simple amendment. We can get that done very quickly for you. So, regardless of this provision, even if you don't have Roth, this might be a good time to go ahead and add it and provide this enhancement to your plan going into next year. And of course, participant engagement. We think it's really important at Mutual of America to provide regular communications and employees to all your participants to help them be as successful as possible in preparing for retirement. So certainly by adding the Roth feature, this gives us an opportunity to come out and talk to staff about this feature and other things that are important to them.
Yeah, Troy, I think that's all some really great points. Just to reiterate, the spirit of the Secure Act in general and its foundation was to help individuals save more for a financially secure future by expanding retirement plan benefits and making them more accessible to employees that maybe previously otherwise wouldn't have had the ability to contribute to. So, but that being said, Secure Act aside, allowing participants to contribute in the form of a Roth contribution has its benefits, as you just mentioned. It's an expanded benefit. It's becoming significantly more common among group retirement plans to allow that contribution type. And so, like I said, Secure Act aside, it's a great time to consider adding it if your plan doesn't currently have it.
Excellent. So let's move ahead and talk a little bit more about how Mutual of America is going to help.
Yes, so for the Roth catch-up contribution perspective, your client relationship manager, and I'm like I said, I'm going to reiterate this often, but is here to help you. But overall, plan sponsors need to identify the Roth catch-up only participants on an annual basis, and you're going to need to report them to Mutual of America, similar to how I mentioned earlier for the long-term part-time employees. You're going to log into our system, what we refer to as OWS, and navigate to the data validation web page and complete the applicable work order. We'll provide reports to you that indicate who may be eligible, right? Who might fall into this category. But ultimately, it's going to be your responsibility to inform us formally which participants this applies to. You should, just like I mentioned previously, you should work with your payroll providers for how they're coding participants for this Roth catch-up eligibility piece. Depending on the data that they collect from you, they may be flagging these participants automatically, which will make it a lot easier for you ultimately to indicate to us who this applies to. But every payroll provider is handling this differently. So again, I encourage you really to reach out to them, get a full understanding of how they'll be indicating or if they're going to be tracking this in any manner. I recognize that I'm getting pretty granular here again, but we will provide more details about the systems and the go live timeline and expectations closer to the end of the year. I will reiterate to please contact your client relationship manager that you have with any questions that you have. They'll be available to support you once this goes live. And I want to assure you that you won't be expected to navigate this process on your own or figure out how it integrates with our system on your own. If you're comfortable with handling it independently, that's great. You can certainly do that. But if you need additional support, which many of you probably will, rightfully so, especially as we do this initially, your client relationship managers will be available to guide you through each step. And the good news is that in most cases, this requirement really only applies once per year. So it's not going to be recurring on every payroll work order. It'll just be once per year.
Excellent.
Morgan,
Thanks, guys.
If I could, I would just add something to that too, which is a really good point that Morgan just made about the sort of the support and the training that Mutual of America will provide. And that is that the IRS recognizes that this is a new provision as well, and that it takes not only plan sponsors some time to get comfortable with it, but also payroll providers and record keepers and all the systems that sort of have to work together. So they understand that, and in the interest of encouraging compliance, they generally have communicated the ability to be flexible, and also have proposed or have issued regulations that have described two pretty straightforward correction procedures that plan sponsors can take if there are errors that occur. And also, as part of Secure 2.0, the correction procedure generally for plan errors have been liberalized greatly and streamlined. So rest assured, we don't expect or anticipate lots of errors, but when errors arise, there are defined and pretty easy to follow correction procedures to get back on track.
Excellent. Thanks, Nick. And thank you both really for your great insights on the Roth catch-up provision. If I'm a plan sponsor, it sounds like I want to connect with my payroll vendor and my client relationship manager at Mutual of America before year end to get squared away on both of these provisions. So, but before we go to a few questions, I just want to highlight once again that we will continue to work closely with all of our plan sponsors on plan amendments and updated summary plan descriptions. That's something that will be happening now and throughout 2026. We are also ready and willing to provide communications and education around all of these topics to you and your participants. And as Morgan and Nick noted, we encourage you to keep in touch with your customer relationship manager to help you guide through these provisions. Bottom line is, we're here to help, and we look forward to speaking with you on both of these important changes occurring in 2026. So we do have some time for questions. So let's see what has come in here. So here's one on Roth. Will my plan participants be required to make Roth catch-up contributions if they're over 50 and earn more than 150,000? Morgan, why don't you take that one?
Sure. Yes. So the answer to that is yes. Starting in 2026, if your participants are age 50 or older and earn more than $150,000 in FICA wages in the prior year, so in this case in 2025, with the same employer, any catch-up contributions must be made as Roth contributions for those participants. This applies to 401k plans, 403b and TDA, and governmental 457b plans that allow catch-up contributions.
Here's a question about the long-term part-time provision. So Nick, listen up. This is a good one. Can you go over the details again for elapsed time plans and the non-discrimination treatment for long-term part-time workers? So 2 parts.
Yeah, it is a 2-part.
Yep.
Yes. Thanks. Yeah, 2-part question. And let me unpack it a little bit. Again, the elapsed time plans generally don't need to comply with the long-term part-time rules. That's because they don't count hours. They credit service on essentially an annual basis for the amount of time that an employee works for you. So that at the end of a 12-month period, if an employee has worked or has service in each month of a 12-month period, they're going to be eligible to participate in the plan, whether they are part-time or full-time. That's for elapsed time plans. For plans that use counting hours, they are going to have to specifically comply with the long-term part-time rules. And then that does mean you have to count the number of hours literally worked by either long-term part-time folks or full-time individuals as well. And as Morgan mentioned earlier, you have to count hours for those individuals. And if they get over 1,000 hours, even if they're classified as part-time workers, they are now what's called former long-term part-time, and they have to be eligible for the plan on a full-time basis. So that's sort of the elapsed time treatment. If you are, again, an elapsed time plan, you don't have to worry much about these long-term part-time rules at all. If you have to comply with these rules, then the non-discrimination rules do come into play as well. And treatment for long-term part-time individuals is that they can be excluded from really all non-discrimination tests. And that's ADP, ACP tests, which is a non-discrimination test for elective deferrals and for matching contributions. They are excluded from coverage testing. And while they're counted as part of top-heavy testing, if your plan happens to fail the top-heavy test, they can be excluded from the benefits and vesting provisions of the top-heavy rules. That gets, again, real technical, real fast. So I'll repeat what my colleagues have said. Reach out to your CRM as needed, and they will help you walk through all these technical rules. The interesting thing that I would note too is that for non-discrimination testing, as I mentioned, they said the rules are that you can exclude these long-term part-time from ADP, ACP testing, and also from safe harbor testing. So if you have a safe harbor plan, even if you have what's called a QACA, which is a qualified automatic contribution plan, which is you can exclude long-term part-time from employees from being automatically enrolled in the plan and from getting the automatic employer contribution, even if you have a QACA. So really, they are cut out from all manner of testing. Now, with one caveat, if you happen to be a new plan, by new I mean a brand new startup plan after the enactment of Secure 2.0, which is in December 22nd, 2022. If you're a new plan after that, and you have to have a mandatory automatic enrollment provision, then you have to automatically enroll long-term part-time employees. But if you're an existing plan prior to the enactment of Secure 2.0, then you can exclude them as well from automatic enrollment and from non-discrimination testing.
Excellent, thank you. A lot of different options in play there, that's for sure. So, okay, here's another one on the long-term part-time provision. How does Mutual of America enroll long-term part-time individuals? So I'll take this one. They're enrolled the same way, but I would say that we will be providing reporting to you to help you indicate who might be eligible. And then, as Morgan mentioned before, that will get incorporated into your work orders, and we will continuously review that based on the payroll that you submit. Okay, let's see. We have time for one more question here. Would you go over?
Sorry, yeah. Troy. Before we go to question 4, I just wanted to on question 3 that you just answered earlier when I talked about work orders and how our clients would need to log into the system. I did reference OWS, and I think many of our plan sponsors know what I mean when I say OWS, but I just want to be clear that what I was talking about with that work order piece is logging into just our general employer plan sponsor portal. So the portal that you normally log into is what I'm referring to when I say OWS. I just want to clarify that.
Yes, good point. Thank you. Okay, so one more came in here. Would you go over what I need to do if my plan doesn't currently offer Roth contributions? Morgan, why don't you take that one?
Sure. Yep. So as I mentioned earlier, if your plan does have a catch-up contribution but does not currently offer a Roth contribution, it will need to be amended to include a Roth contribution option before 2026 to allow catch-up contributions for participants earning over that $150,000 FICA wage threshold. Otherwise, if not, their traditional or pre-tax catch-up contributions that they make will be blocked and they will not be able to contribute those. So you're going to want to amend the plan to allow for Roth contributions so those participants can contribute catch-up contributions.
Very good. Well, I think that that kind of wraps up our material for the day. So Morgan and Nick, I want to thank you both for sharing your knowledge and insights with us today.
Thank you, Troy. And thank you, Morgan.
Thank you.
Well, that's all the time we have for this webinar. Thank you so much for joining us. Again, you can download the slides by clicking or scanning the QR code on the screen that you see in front of you now. And before you leave, please take a minute to complete our brief survey and let us know how we did today. Finally, today's webinar will be available soon on mutualofamerica.com to watch at your convenience. So thanks again for joining.